Our first speaker will be Professor Deborah Lucas. Debbie is the Sloan Distinguished Professor of Finance. She came to us in 2012 via Northwestern and the Congressional Budget Office. She is currently teaching an advanced fixed income course and is the director of our new MIT Center for Finance and Policy. Her topic today is Towards a World Atlas of Government Financial Institutions, where the center is planning on systematically cataloging the role of government in the financial sector around the world. Let me turn it over to Debbie.
Thanks, Eric. Okay. Well, hello, good afternoon. It's quite an honor to be here and to talk to all of you. As Eric said, I came to MIT with the prospect of getting the CFP underway. Actually, the history of it, I think, is that it's the brainchild, as many things around here, of Bob Merton and Andrew Lo. They talked about the need for more research and finance that addressed public sector problems, regulation, government investments. They knew this was something I was working on, and I got the call from Andrew, who is an old friend of mine, and he said, would you like to come to MIT? And I said, well, of course, I'd be delighted to. The reason is really all of you here. It's a fantastic alumni group platform to talk about these important issues. So first I have to figure out how to make this work, then I will keep talking. There we go. Okay, so what I want to do with the time I have is to give a bit of an update on what's going on with the Center for Finance and Policy. I know some of you have heard about this, some of you haven't. And then I want to talk to you about one of the projects we're working on in connection with the center, which is this World Atlas of Government and Financial Institutions. I want to make sure to leave plenty of time to hear your thoughts on it, so I hope that someone is going to cue me in. They are. The time is right there. Excellent. Good. So, okay, so this is an MIT-wide interdisciplinary initiative led by Sloan's finance group. So I'm the director. Doug Cristicello, who is here, and I hope a lot of you have a chance to meet, is our new executive director, and he comes to the CFP with an amazing background both in public service and in the private sector, so really well positioned to help with all the initiatives we're involved in. And then Andrew Lo, Bob Merton, and Andrei Kirilenko are co-directors, and they also have a large input into what we're doing. So basically, our mission is to produce timely research at the intersection of finance and policy that will lead to improved decision-making by policymakers and regulators, and also to create educational initiatives to do basically the same thing, to make the state-of-the-art financial tools that many of us take for granted because we've learned them at MIT and we take them to the private sector, but to make those same tools both relevant and accessible to students of public policy, to employees of public institutions, to policymakers, and to regulators. Okay, so in terms of the research of the CFP, we've organized it under three main tracks. The first is the government as a financial institution in itself. This is one that sometimes takes some explanation, but I think it's extremely important, and it's an area that really isn't served by other academic institutions. I've said many times, and I'll say again, that governments are by far the world's largest financial institutions. Through their credit activities, through their guarantees, through their insurance operations, and they do this in different ways in different places. In the United States, the biggest footprint is in our mortgage market and in student loans. In other countries, The bigger impact is through state-owned banks and other financial institutions. But however it turns out, these institutions are huge in the allocation of risk and capital in society, and relatively little research has been devoted to them. So a lot of what we're doing is to try to inform on the activities of these institutions and their implications. The second track, regulation of financial markets and institutions, is obviously extremely important. Many of you in your jobs are constantly struggling with regulation and making sense of it, having to respond to it. We need regulators who understand finance, who understand the implications of those regulations, and we hope to be creating research that will objectively inform on that. The third area, which is one that is very near and dear to Andrew Lowe's heart, but also to mine, is the measurement and control of systemic risk. We saw with the financial crisis how interconnected the financial world is. We need to understand the implications of those interconnections. We need to try to understand when these kinds of crises might be coming, what might be an early warning signal, how to manage it. So the CFP is involved in those three tracks. So what I'm going to talk about today, the World Atlas of Government and Financial Institutions, is part of that first track. But as you can see from this list, we're really working on a lot of interesting research projects that we'd be happy to talk to you more about. If you can also send me emails, so I'll answer emails too. Okay. I don't want to go on too long about the CFP, only because I want to make sure we have enough time to talk about this new project. But I want to invite you to come visit our website, which is here. We have quite a bit of information about what we're doing. We launched in September of last year, and we have quite an active number of activities going on campus and elsewhere. We've brought through some very good distinguished speakers. We have visiting scholars. One thing that's wonderful is the students spontaneously created a club called the Finance and Policy Club to explore the same kinds of issues that we want to work on with the center. And in fact, we have a group of students who next year are organizing a trek to Washington, D.C. to try to make connections so that some of our students can be employed to bring their financial skills to the public sector. And then last but not least on this list, we are running annual conferences. We had a very nice one last September. This year, we're going to be focusing on retirement issues, certainly a place where there's a strong intersection between finance and policy and the private sector. So we're looking forward to that. Okay. So Wireworld Atlas of Government and Financial Institutions. Well, as I said before, the governments of the world allocate a very large share of society's capital and risk through their credit and insurance-related activities, mortgages, student loans, state-owned banks, pensions, deposit insurance, other contingent guarantees, and the like. But in fact, these government financial institutions are far more opaque than their private sector counterparts. And because they are so large, and because they are opaque, in themselves represent a significant source of systemic risk. Their costs and risks are simply not well understood. They're not well measured because governments don't force themselves to measure them well. And I think if you looked at their accounting, you would agree that they're inadequately accounted for. So basically, the goal here is to fill some of those gaps by providing information on these issues. As I mentioned before, there's been surprisingly little research in this area. I'm not an expert on the sociology of academics, but it does. I've been one for a long time, and it perplexes me that this area hasn't been one that has gotten more attention. There's a fair amount of low-hanging fruit. There's a lot to be learned. And again, I feel that MIT and Sloan is an ideal place, if you will, to maybe nudge intellectual fashion a little, to try to get researchers all over the world to be more interested in this. Also, maybe surprisingly, there is no comprehensive measure of the size of government credit market or insurance market activities for most countries. it's the nature of these programs that people focus on their little corner of the world. Some people are concerned about student loans, some about pensions, some about retirement finance, but there really hasn't been a big overview of these different activities and how they compare internationally. And aside from not measuring the size of them, there's been very little evaluation of whether the programs work well or work poorly and what could be done to make them more effective. So I want to just show you, in terms of the issue of the size, actually there has been some work done, particularly for the United States, on how big the federal government is as a financial institution, and it's kind of indicative of what we'd like to try to do for countries all around the world. And this is a chart, maybe some of you have seen me shown before. It's from research that I did a while ago, and so I guess it's self-congratulatory to call it a decent compilation. I think we could still make more progress. But here's the story. If you look at the US government, if you look at deposit insurance, which covers about $7 trillion, Fannie and Freddie, which is up there at about $5 trillion, what I call traditional credit programs, that includes student loans, FHA lending, loans to farmers, business, trade, then pension guarantees, the home loan banks, and the farm credit system. You add that all together, and you find that the federal government, in terms of assets where they're taking some kind of credit risk, is about an $18 trillion financial institution. And sitting there next to them, I've put Bank of America, JP Morgan, Citi, Wells, Goldman, who start looking rather small in comparison. So there's where you kind of see the footprint of the government in the financial space. Okay. So quite interesting. Okay. So let's talk about the rest of the world. So a few years ago, I had a very US focus because I had been working at the Congressional Budget Office, and that's what I was thinking about. But actually, I was approached by the OECD and asked to look at these same sorts of issues for the rest of the world. And it was really eye-opening. And in fact, MIT is a very international place, and the CFP has a very international focus. And financial problems are universal, so we do have a lot of interest in covering the international scope. So what I'm showing you here is that the IMF does care about these issues, and they've compiled some data on what's happening in OECD countries. And here you can see some tallies of outstanding government-guaranteed bonds and debt of government-related enterprises for OECD countries. I guess the summary statistic here, two of them actually. One is that for many of these economies, these obligations represent roughly 20–25% of their GDP, so really very large in other places too. The other things you're seeing there is you're seeing red diamonds versus yellow bars. The yellow bars are 2008, pre-crisis essentially, and 2012 is post-crisis. So these obligations have gone up with the financial crisis, but they were very large beforehand too. So this is not just an artifact of the financial crisis, it's the steady state of the world that governments are playing a very large role here. So these IMF statistics are useful, they're a good starting point, but they're by no means comprehensive for reasons I won't go into. So there's still a lot of work to be done in this area. Okay, so what do we want to do? So this is more like a research agenda than a done deal, although I'll show you some results and some things. But the first step, and this is quite a challenging step, is to create a really good template for data collection and for the questions that we're going to ask. The reason this is so complicated is that government interventions in financial markets take quite different forms in different places. As I said, in the United States, we have a large number of government credit programs run by agencies of the government. Those are actually less prevalent in other countries. We have relatively little in the way of state-owned banks In other places, those are the main form of finance in the economy. So we need to be able to encompass these different institutional structures in a way where we can look at those metrics and make them as consistent and comparable across countries as possible, so we can really ask what works, what doesn't. Now, what we have at MIT, which is just amazing, is what I think of as an army of students who are willing researchers to go out and help with projects like this. And so what we actually have been doing is opportunistically taking advantage of students from different parts of the world who want to become engaged with this and sending them out and having them come back with the answers. So just to give you a little bit of an example, I had a student from Egypt who was very interested in thinking about the Middle East, and he went out and tried to gather some of this data for the Middle East. Now, that had to be the hardest place to start. We'll return to the Middle East at some other point in time. So apart from having this great resource, which is students who have both the analytical and the language skills to do this, it also gives the students sort of an entree into this world, and hopefully some of them will go out and wind up working at these institutions and making them better places. In any case, aside from collecting the data, there's really a need for better methodologies for how to think about the costs and the risks of the obligations that these institutions are making on behalf of their citizens. And so developing those methodologies for valuing subsidies, for measuring risk exposures, is also a big part of the phase 1 part of the project. So as we're doing this, the goal is to make the results as available as possible to researchers, to policymakers, to the public. Some people sometimes ask, are you worried about competition on projects like this? And my answer is always, we're not at all worried about competition. We're really worried that no one is paying any attention. So we would like to make this information as available as possible to the world at large, in the hope that more work will be done on these issues. Okay. So phase 2, of course, is not just getting basic statistics, but using them for serious analysis. So what do we want to look at? Well, there's some big questions here. Understandably hard to answer, but nevertheless, I think with more data we can make some progress. So the really big question is, what are the effects of these government financial institutions on economic activity, on efficiency, on growth? And so that's the macro. That's the macro question, which of course we'll need other data too on macroeconomics of the economies. But at a more micro level, I think a set of important questions are, what works, what doesn't work, why? So hopefully the data will be useful in helping these institutions do better. A question that's been very much part of my own research agenda has been, how large are the subsidies? I think that's obviously important for a lot of reasons, but let me give you an anecdotal reason you might not have thought about that was very interesting to me. So as I mentioned, I started to work on all of this in an international context when the OECD asked me to do some work. And actually what they asked me to work on first was the question of energy subsidies. So let's say that you're interested in climate change, and we know that governments everywhere give enormous subsidies to energy, both to fossil fuels and to alternatives. And they wanted to ask the very reasonable question, what are we subsidizing more, fossil fuels or alternatives? Well, interestingly, they can't answer that question very well. And the main reason they can't answer it very well is that so many of the subsidies are in the form of credit subsidies that they don't have information on the size of those credit subsidies. And the reason is because governments are not collecting or not reporting on information on those subsidies. And to the extent that they are, there's no standard way that they're being reported across different countries. So I think actually the OECD, the IMF, are interested also in these methodologies that would create these more standard kinds of reporting. So I couldn't answer, by the way, I couldn't answer the question. There was a lot of credit subsidies on both sides. So the paper I wrote was more by way of methodology and example and to point to what they might be doing differently. So I can't tell you who gets more subsidies. I wish I could. OK, and so again, we want to make the results accessible to a wide audience. OK, so I wanted to also talk to you a bit about the challenges that we're facing, because some of you might have some helpful suggestions on that. I started out with a bullet point where I felt I had to say this, which is counting is not easy. In some ways, this feels very low tech, but it has a lot of conceptual minefields. And I think what's going to be so important for whether this project really has an impact is getting the questions exactly right. So some of those issues I wrote down here. There's a question of scope, because you can think of what governments do in general as finance. I always like to quote Peter Fisher, who says that he thought of the federal government as a giant insurance company with a small side business in national security. So, so if you look at the government broadly, there's a lot of finance going on. But just to name some of the really difficult things. So government guarantees are huge. Deposit insurance, too big to fail, et cetera. But do we look at the explicit guarantees, or do we also include the implicit guarantees in what we're trying to measure? I'll tell you what my predisposition is, which is to start with the explicit guarantees, because I think there's so many implicit guarantees out there that you take a little bit of credibility away from the exercise by trying to say, to try to put in the mouth of governments guarantees that they haven't actually explicitly given. But people are very interested in measuring implicit guarantees, so that's one of the questions, a dividing line. On the insurance front, there's guarantees which are more financial and guarantees which are less financial. So health insurance is a great example. Health insurance is one of the largest guarantee programs of most countries, yet I think of it as a kind of insurance which is certainly extremely important, but maybe outside of the scope of a financial institution. And then there's just questions about what kind of data is available, how deep do you go. So one more that I would love your help with thinking about, because I know some of you have experience with these institutions, is in a lot of countries, as I mentioned before, state-owned banks are the largest tool probably of industrial policy in those countries. But the government doesn't always own the whole bank. They often have a majority stake, or they somehow have some control. And how do you measure those state-owned banks? Okay. Then a final consideration is just choosing metrics and methods that are informative, but yet simple enough to talk about, to explain to policymakers, to explain to the public. So a lot of challenges. OK, so what's the status of all of this? It's not just a pipe dream. We've done some significant work on methodologies for subsidy estimation and risk evaluation. And a piece of the program where, for various reasons, I decided to turn to it first was on the topic of development banks. And that's what I'm going to talk about in a little bit more detail today, because I think it's an interesting example of some of this. So in the area of development banks, there's several papers that I have been working on, along with a variety of co-authors and students, on the methodology for the subsidy estimates to those development banks. The European Bank for Reconstruction and Development and the Korean Development Bank are the two cases in point. I have some colleagues in Brazil who want to work on BNDES, which is the big development bank in Brazil, one of the largest development banks in the world. Okay, and we've also started to collect data generally for part of the atlas. Okay, so let me turn, with some of the time I have left, to development banks, because I think these are fascinating and a great example of where governments are having a large influence, which isn't necessarily being measured too well. So as many of you probably know, development banks are a major source of capital for infrastructure spending around the world. They also provide funds to other big investment projects in the public sector and in the private sector. What's been in the news the most of late has been the new Asian Infrastructure and Investment Bank. It was started at the initiative of China, who wanted to have more of an Eastern view of what was worth investing in. And so they put together this bank in cooperation with more than 50 other countries that are founding members to provide capital for projects in that part of the world. As you probably heard, the US kind of pushed back, but it's a reality, and there's going to be this new large infrastructure bank. These development banks fall into two broad categories. There's development banks that just belong to a single country, so in some sense they're just a state bank. And there's also these multilateral financial institutions, of which the AIIB is going to be the newest. So just to give you a sense of the size, again, measuring in terms of assets, there's not always very recent statistics on this, but the best I could find was that for single country banks, a subsample of 90 out of, I think, 253 that were considered in this study who had reported to the study founders, that was about over $2 trillion of assets in 2009, and then these multilateral banks were on order of 1.2 trillion in assets in 2012. So again, quite big financial institutions on the scale of world financial institutions. The particular study that I'm going to tell you a little bit more about was for the European Bank for Reconstruction and Development, which is just one of these multilateral banks. But this shows you the list of the major multilateral banks. So the largest on this list is actually the European Investment Bank. I think it's in much the same business as the EBRD. The World Bank Group runs a lot of these institutions also. So these are the numbers that total to about $1.2 trillion in these multilateral development banks. Okay. Okay. So how are these banks funded? It's an unconventional funding model. The way multilateral development banks are funded is that in terms of equity capital, what they rely on is pledges from their member countries in the form of callable capital. And that capital is made available basically to absorb any losses that they might experience, or to keep them capitalized to an adequate level, and thereby keep their cost of borrowing quite low. When they're making those investments, most of the way they fund those investments is through debt issues, many times in international capital markets. And those debt issues tend to have very high credit ratings, maybe AA. But again, that high credit rating, that AA credit rating, is there because of this callable capital, which is pledged by these member countries that allows them to top off the bank in the event that they lose money. You might wonder whether the providers of this capital get any return beyond the benefits that the bank provides by their investments. And as far as I know, these banks don't return dividends to their members. So it's really callable capital. Goes out, doesn't come in. Okay. So the callable capital allows the banks to demand payments from the members if equity falls below a threshold. And so therefore, as we learned from Bob Merton and other people at MIT, member countries are basically writing call options for these development banks. Okay. So what I should say up front, and some of you might be wondering, is this a diatribe against development banks? And I want to say by no means am I against development banks. They may be the best source of capital for these kinds of projects. They might be funding the right things. But what I want to talk about here is transparency and understanding of the costs that are involved in these obligations. So what's very important to understand is that the governments who are writing these calls generally recognize no cost of the call at all until it's called upon. So if there was a year where these banks lost a lot of money, you would see ex post the amount of dollars going out. But up front, when they're making the commitments to participate in these kinds of organizations, there's a zero budgetary cost for these countries. So part of this agenda of thinking about these institutions and calculating subsidy costs is to ask the question, well, these calls really aren't free because ultimately the money has to come from the countries that are providing the money, so what is the cost of that callable capital? And before I give you information on the cost, let me just show you that for the European Bank for Reconstruction and Development, this just shows you the kind of exposures of the members. So I've given you there's a lot of members. I think there's 30 or 40 capital contributors. But for the European Bank for Reconstruction and Development, even though it's not European, the United States has the largest capital subscription at about 3 billion euros, and then France, Germany, Italy, basically large countries come in next, and then everyone has a little piece of it after that. Okay, so that capital subscription is the maximum amount that could be drawn on any of those countries. Okay, so how do we go about thinking about the value of those call options? Well, basically, that's a general question that helps you answer all kinds of questions about government guarantees to state-owned financial institutions. The particular example I'm showing you here, you can see in detail the model in a paper that I wrote recently on evaluating the cost of government credit support in the OECD. But basically, you can use a structural modeling approach. You can look at the current assets and liabilities of the banks. You can infer asset volatility by looking at the kinds of loans they make and drawing analogies to private sector banks. Something I think which is a little bit new methodologically in thinking about using a structural model for valuing guarantees of these government banks has to do with what you assume about the capital structure. One of the big challenges to structural modeling of options related to financial institutions is that they don't have one issue of debt that you either hit the boundary or you don't. In fact, they're adjusting their debt all the time, and they run on very thin capitalizations. So the results you get about the value of the call options are very sensitive to what happens to leverage over time. So actually, as practitioners, some of this might be of interest to you too, but trying to innovate in the space of how do you take a structural approach. I am actually quite a believer in structural models. Bob has convinced me of that, but how do you make them appropriate for financial institutions? So that's the methodology, and I'm not going to, luckily, pull you through any of that. But I will say that if you believe the assumptions that were made for the EBRD in that paper, you would estimate that if you thought about the cost for all the members up front, capitalized cost over 20 years, would be about 7.2 billion euros. Okay? So it's not a staggeringly large number, but it's a lot bigger than zero. And so in terms of decision relevance for governments, they may think it's well worth their share of that upfront cost to get the benefits of what these development banks are doing. But right now, that information is completely absent. So this is the last slide I have, but I just wanted to add a few more things. So this is just one example for a not too large development bank. Recently, I've been working with one of our MFin students who's from Korea on improving the methodology and applying it to the Korean Development Bank, and we just finished that work. I'm off to Sweden tomorrow to give that paper. For the KDB, we estimate that their cost is about 25% of their asset value, so sort of on the same order as EBRD. I have to tell you this story, though, of Sung, because not only did he graduate from our master's program, but working on this project was at least one thing that helped him gain admissions to NYU next year as a PhD student. So I think he's going to continue working on these kinds of things. So I'm very, very proud of him. Another estimate that we've done recently, which I think is interesting, is there's another facility with callable capital called the European Stability Mechanism, which some of you might be familiar with. It was put together by the European countries to create funds in case the countries were unable to go to market, think Greece, and it would provide money to them. So in that case, there's 700 billion euros of callable capital out there, which, by the way, is the same size in euros, except not in dollars, as what the US TARP was. So that's callable capital exposure of 700 billion. And as far as I know, I'm the only person who has done any kind of an estimate of what that actually costs, because those countries credited themselves with no cost at all of signing those treaties. So again, that treaty might be wonderful, but having information about the costs is important. So I'll stop with that, and I would be happy to take your questions. Thank you.
Thank you. Considered as financial institutions, how large are the post offices of various countries? I'm thinking of US versus Japan, but anywhere else.
I have no idea. Pardon? Oh, and the Japan Post. Are you talking about the postal savings system? Yes. Oh, I'm sorry. You were talking about the you said Japan Post. I thought you said the post office, and I was.
Japan Post, we give money to our post office, and they'll buy stamps. In Japan, it's very different, so order of magnitude different, but it is.
Right. So we have a lot in the world. There are many, many government-owned finance. So the Japanese postal savings system is sort of off by itself and different. So I don't know enough about it to really address it. But in terms, we also have a lot of state-owned enterprises. And again, this is a question of where you draw the line. So state-owned enterprises actually do also benefit from access to government capital. And a lot of the issues about valuation of capital are also true for the state-owned enterprises. And it's something else that I've been thinking about, but outside of this project of the World Atlas of Government Financial Institutions, because aside from the Japanese postal system, our post office is not particularly financial. I mean, the other big US-owned company is the Tennessee Valley Authority, which is probably the largest US-owned government corporation. It produces about 1/6 of the electricity in the United States, and I've actually estimated the size of the subsidy to them in under-recognized equity capital from taxpayers, but again, it wouldn't be part of this project.
Hi. Just in terms of the guarantees, the callable capital, have you thought about factoring in their counterparty risk of the ability for them to ability or willingness to actually deliver on those commitments in those different situations, and
right.
whether or not that increases other countries' actual requirement?
That's an interesting question. I think to the extent that they might default on these commitments, I guess that lowers the cost to the government. So this is actually an estimate of what it would cost if they carried through with their promises. If they fail to carry through with, you do have to wonder about some of these large treaties, how firm they really are. And in fact, in the US context, we have, as you could see, even in these European institutions, the US has large subscriptions, and there are political forces in the United States that would like the United States to say withdraw from the World Bank, but at least so far we've always honored our commitments. So it seems a lot of these are, I'm not a lawyer, but they're established in treaty, and so it would be a big deal to abrogate on these commitments. Though in the case of a very serious crisis, there's clearly a question about that.
So on the slides you presented, the first couple of slides, I didn't see central banks included as part of the government. Do you consider them part of the government, and how would you, or in which cases it's appropriate to consider them part of the government, and how do you account for the risks involved?
Yes, thank you. So I certainly think central banks are part of the government, and I think they pose considerable risks. And it's something where I think over time we might do something in that space. The space I already described, So let me say that I think central banks are already massively studied by economists, by academic economists. Basically, macroeconomics, monetary policy is a large field. And what we really wanted to do with this center was fill a space that no one is filling. So whereas there's a lot done on monetary policy, surely we could do more and we'd like to do better, these other institutions have extremely little coverage, and they're doing a lot in the world. So I think it's more that we were just, I was focusing on the things that we were trying to fill in.
There was an article in the popular press about a week ago.
Thank you.
Excuse me. Estimating similar things that you're estimating, admittedly including some of the implicit guarantees. Mm-hmm. And their takeaway was that as a percentage of total financial obligations in the US, that the government currently, I think the number was about 60%, and that's essentially been unchanged since about 2008, despite all of the focus on Dodd-Frank and the like. What do you think are the biggest structural impediments to the US government reducing that guarantee over time? Because it seems like they want to, but so far they really haven't.
Right. So certainly the place where the government is the biggest and where there seems to be consensus on both sides that the government should pull back is in the mortgage market. And if you follow the politics of the mortgage market, there's actually surprising consensus in the middle. So there's been several bills proposed that would start to bring private capital back to the mortgage market and phase out the dominant role of Fannie, Freddie, and the FHA. There's just, I guess, a one-word answer to why not, and that's Congress. So I don't think that Congress has been willing to pass any significant policy on anything, much less reforming the entire mortgage market, which should be a top priority, but it requires, I think, more of a spirit of cooperation than what currently is going on. So hopefully with the new administration and new Congress, some progress can be made. But I think it's an area where there's quite a few good ideas and a surprising amount of consensus. So I have a tiny bit of optimism that we might move in the right direction eventually.
Let's take one more question.
How do you, in your analysis, factor in the moral hazard that gets created by investors when they know there's a backstop? Right, folks take on risks which they really wouldn't take on if they don't think there's a backstop, and that's money that gets lost by, say, like pension plans or other investments.
I have another lunch I have to go to.
Well, what I have to say is when you're looking at the subsidy estimates for any particular institution or program, you try to take into account the behavior that's there, and that behavior is affected by moral hazard and adverse selection, everything else. And really, the emphasis of all this analysis is to be as data-driven as possible, so you can see historical defaults and all from these kinds of programs. So what we're not doing in this kind of what I would call partial equilibrium analysis is asking the very important question, how does all of this impact the macroeconomy? How much are we distorting the total allocation of capital and risk by subsidizing things through the government? Of course, that is the trillion-dollar question, and that's what we want to be informative about ultimately, but haven't attempted that ambitious answer yet. Thank you.
Thank you, Debbie.
Thank you.